Why? By February, everyone's already set up their positions. Shorts pile in, but they hit a wall at 70. There's a real deficit coming, 15 million ounces short by 2026. That starts to matter when China's stimulus finally kicks in, industrial demand bounces back, and the whole buy the dip crowd gets wiped out. Most people ignore Wersh's hawkish streak, but it's a problem. His bias cuts off any easy rate cuts, and the Fed's stuck with ugly choices. They can't kill inflation without risking a recession, so volatility stays high. Bulls are getting trapped right now. Pieces are already moving. The U.S. Mint stops selling coins in January 2026 during a rally, signaling physical silver's tight. Miners hedged about 20% of their output above $90, but those bets are underwater if silver drops under $80. That's where everything gets stress tested. If leverage gets flushed out, $80 could be the floor, and we might see a bounce back to $95 if the dollar peaks. But if inflation comes in hot in February and Wersh hikes rates, $70 gets tested. That's a rough reality check. A 15% drop isn't some fluke. It's just the market rebalancing and showing how exposed silver really is to Fed policy before any industrial recovery kicks in. So how do you play it? Stick to basics. Diversify, don't over-leverage. Keep your eyes on real yields and the dollar index. Favor physical silver over futures, or trading the chop. This isn't wild speculation. It's just following the incentives. The system's boxed in. Debasement is forcing a mean reversion. But those supply deficits are real, and that's what drives silver over $100 by 2027. Now you see how it works. Most people just chase headlines. Survivors follow the logic and track how the pieces fit together. If $80 breaks, brace yourself. If it holds, silver's heading up. Don't fall behind. The market always rewards people who watch the mechanics, not the memes. Second, you've got positioning and flows. At the end of 2025, managed money was net long silver futures at historic levels. Over 60,000 contracts, or 300 million ounces, on thin open interest. News about Wersh triggers CTAs and quant funds to break the $100 support, dumping 5 to 10% of volume almost instantly. JP Morgan warned of a $50 crash. It sounded crazy, but fundamentals and price got totally disconnected. Silver acted more like a macro trade than a store of value. Now, incentive funds face redemptions as risk comes off the table. Miners like Pan American get squeezed if silver stays below $80. Short-term, flows reverse. 2 billion left ETFs on January 30th alone, just like the 2011 flash crash. Third, supply and demand are out of whack because of policy volatility, not just some fixed deficit. Sure, the Silver Institute pegs 2025 demand at 1.12 billion ounces, supply at 1 billion. Solar's up 15%, EVs 20%. But that's business as usual. Wersh's hawkishness slows global growth. U.S. GDP forecasts drop 0.5% if rates stay high, which cuts industrial demand by 3.5%. Sentiment does the rest. Retail FOMO drove half of silver's 2025 gains through apps like Robinhood, but now the pros are unwinding. Add in Trump's 25% steel tariffs, which jack up input costs for silver users. The strong dollar, though, kills some of the hedging appeal. Policy solutions like targeted cuts just make it worse. Wersh will probably stick to the rules, let recession risk build, and force silver to trade at a discount to gold, pushing the ratio to 90.1. The whole chain, nomination, hawkish signals, growth fears, weaker demand, a test of 80, holds unless there's another big unwind. These forces all feed into each other. Tight policy puts pressure on traders to reduce positions, which exposes how fragile demand really is. That's the real story behind silver's wild ride. Look at the near future, and things start to snap into focus. The pattern's clear. If Wersh gets the nod by March 2026, the Senate rushes things through, and the Fed just keeps rates parked at 4.55%. QT keeps humming at $50 billion a month. The dollar crawls up to 105 on the DXY. Yields stick around 4.5%. Silver hangs out in the $75.85 range through the first quarter. The dollar jumps, DXY up 0.8% just on the announcement, and silver drops since it's priced in dollars. Big institutions, which make up more than half of physical silver demand, suddenly face higher borrowing costs. Futures traders, who are usually leveraged 20.1, get hit with margin calls first. It's a chain reaction. Yields spike, the dollar rallies, speculators unwind, and prices cascade lower. Hedge funds cut risk before things get even choppier. Miners start thinking about cutting output if it gets too hard to raise cash. Supply's tight at 1 billion ounces. You can't just double mine output overnight. Why's all this basically inevitable? The Fed's hands are tied. Debt service now eats up 20% of the budget. Tariffs tack another 1–2% onto CPI. Warsh's tough stance kills the money printer go brrr dream. TIHI gold-silver ratio just blew out to 80.1. Major warning sign of overbought conditions. Now you get mean reversion. Silver's testing $80, with 2025 lows clustered around $71. This isn't random noise. It's the incentive structure in action. Look closer at the 3 big forces driving this. First, the central bank's stuck in hawkish mode. Warsh isn't Powell 2.0. He's the guy who warned against endless QE in 2010 and pushed for letting markets price risk the old-fashioned way. The Fed's $7 trillion balance sheet limits their options, and with Warsh, runoff speeds up. That pulls liquidity out of risk assets. Silver, basically a leveraged bet on easy money, takes the biggest hit. Real rates go positive after the nomination, so the cost of holding silver jumps, and money flows out of ETFs, which soak up 20% of next year's supply. Meanwhile, the dollar's strength cuts into demand from emerging markets. If China's yuan drops 5%, their solar boom slows. India pays more for imports. HSBC had silver averaging $33 in late 2025, but speculation sent it higher. Warsh brings it back to earth, with BOFI looking for prices between 56 and 65s, a move that explains about 10% of the recent drop. Every carry trade feels the pain. This is where things start to get shaky. Silver is weird. It's half industrial metal, half monetary hedge. That makes it super sensitive to shifts in Fed policy. When Warsh's hawkish reputation showed up, the whole debasement trade story fell apart. No more fear of a Fed printing press gone wild. Investors bailed out of metals and moved back into dollar assets, unwinding last year's Trump trade that sent silver up 180%. And this 15% drop in a single day? That's not the bottom. Silver's now testing $80, a psychological line in the sand where December 2025 data showed speculators had stacked up more than 50,000 long contracts betting on endless deficits. If $80 breaks, $70 comes fast. If it holds, silver might settle and bounce back on real fundamentals. By the end of this, you'll see why Warsh is forcing this moment, and how deeper forces are shaping what comes next. Let's break down the real mechanics, because most people just toss around headlines without understanding what's actually happening beneath the surface. Silver prices don't just move on vibes. They're all about the push and pull between how money flows through the system, what makes capital want to stick around, or leave, and how traders position themselves in a market that's always one step away from a big move. Let's start with the Fed. Under Powell, everyone expected the same easy money, rate cuts down to 3% by mid-2026, and a slow balance sheet runoff so markets wouldn't freak out. That kept real yields below zero. Holding silver barely cost anything, so ETFs ballooned, and by 2025, industrial demand hit a record 1.12 billion ounces, according to the Silver Institute. Now the banks, like JP Morgan, are raising red flags. The supply deficit has widened to 12 million ounces, and the squeeze is on. Enter Warsh. His track record? Hardcore rules-based tightening. He's slammed bond buying for messing with markets and demands the Fed focus on inflation targets without caving in. The Senate confirmed his nomination. Now he steps into a Fed that's stuck. CPI is still running hot at 3.2–3.5% as of December 2025, and fiscal deficits are blowing up after new tariffs. But if they cut rates, inflation comes roaring back. So what happens? Hawkish policy gets priced in fast. Silver just took a beating, down 30% in a single day, crashing right through that key $80 support as Kevin Warsh's Fed nomination landed like a punch to the gut. If you're holding silver right now, hit that like button and subscribe so you don't miss how this structural shift plays out. We're about to walk through exactly what's happening, step by step, and you don't want to miss how this all shakes out. Here's the thing almost nobody gets. This isn't just some wild, random price swing. What you're seeing is the mechanical unwinding of a trade that's been building for over a year, one based on fears of currency debasement. Wirsch just lit the fuse that exposed the cracks in silver's wild rally. Think about it. Silver shot up from under $30 last year to over $120 just this week. That's triple your money in months. 264% gains in 2025 alone. Everyone jumped in, chasing the story about industrial demand from solar and EVs, plus that safe haven angle with tariffs and government debt in the headlines. But let's be real, that run was never built to last. It was all about leverage, thin futures markets, and a dollar that just couldn't keep up. Then Trump named Wirsch as his pick for Fed chair on January 30th, 2026. Remember, Wirsch is the guy who pushed back on QE in 2010. He's tough on inflation A6 and wants to hike rates, not inflate the balance sheet forever. The market took this as a sign. The Fed's staying independent, no more easy money, no more big rate cuts. The dollar jumped almost 1% right away. 6 10-year yields ticked up to 4.25%. Suddenly, silver nosedived from 113s to around $80 as stop losses hit, and algorithms dumped positions.